Good evening, sir. We are Team Fortuna, and we initiated buy coverage on PVR Limited with a target price of 1227.3. PVR as of date operates 557 screens in 112 properties spread across 48 cities in the country. The major concentration being in the western and the northern part of the country. PVR enjoys a competitive advantage of by wisely choosing its properties in premium locations, so as this enables the company to charge a higher ATP in comparison to its peers. So this is the competitive advantage that PVR enjoys. Drilling down the revenue segments of PVR mainly has three major sources of revenues. The first one being the cinema exhibition business, which contributes to around 53%. The second one being the F&B business, which contributes to around 25%. And the third one being the advertisement revenue. The other sources of revenue being, to name a few, like PVR Blue, which is the bowling alley business, and PVR Pictures, which is the distribution arm of PVR. So these are the revenue projections. Talking about the growth story of PVR, its asset base has been growing at a CAGR of 28% over the past 4 years. The company has also been able to clear off a certain amount of debt, as can be evident by the fall in D by E ratio from this slide. PVR is actively involved in CSR activities through its the CSR wing called as PVR Nest. It has been able to enable social transformation in the society by leveraging with multiple institutions, because of which it has received accolades for that. Talking about the board of directors, the board of directors comprises of 8 members, and out of which 50% are independent and 50% are non-independent. The promoter stakeholding in the company is almost around 25%.
Coming to the industry analysis, multiplex industry analysis, the number of multiplex screens has been increasing at a CAGR of 15%, the number of single screens has been decreasing at a CAGR of 6%, showing a great growth potential. The high grossing movies has been increasing from the past 4 years, with almost 350 Tamil movies and 15 Malayalam regional movies being produced in 2015 alone. So the screen penetration is lowest for India, with almost 6 screens per million population, which shows a huge growth potential. Also, the average ticket price is very high for high-end multiplexes, citing higher revenues and higher profits. So if we talk about the film revenue is also increasing at a CAGR of 13%, which is the main driver of this industry. Apart from these 5 factors, the rising GDP, the rising purchasing power, the high F&B strength will lead to a higher growth potential. So PVR also boasts of 35% percentage share in Hollywood and 22% share in Bollywood box office prices, and also there is the highest admissions per ticket. So talking about the weaknesses, so weaknesses lies in basically in the higher ticket price. So the higher ticket price basically leaves out the lower middle class, and there is also the problem of parking in most of these multiplexes. The opportunity lies in the GST rates, which we will discuss in valuation, and also the rising internet and smartphone, which will increase the online booking thing. The threats lies in the piracy and the slower demand of malls. The threat of new entrant is low because basically there is a high capitalization in the beginning, and there are a lot of regulations involved with this industry. The bargaining power of supplier is quite high because the distributor takes in almost 50 to 60% of the revenues, and also there is a heavy consolidation. The threat of substitute is also low, although there are very DHS services and all the top services, but the experience of cinema is hard to replicate. The threat of rivalry is high because the 4 companies constitute almost 80% of the market share, and the bargaining power of buyer is also low because there are less substitutes available with the buyer. Talking about the competitive analysis, so the largest competitor of PVR is Inox, followed by Carnival Cinemas. The number of screens for PVR is highest, followed by Inox, but the presence in cities is for highest for Carnival Cinemas, and it is also planning the higher aggressive expansion plan with almost 30,000 cinemas by 1,000 screens by 2018. So talking about also from the previous acquisitions, we can also see that Carnival Cinemas has acquired almost 250 screens in past 4 years by acquiring the big cinemas. So it's also expanding its footfall in tier 2 and tier 3 cities. From this graph, we can see that this is the PVR, this Inox graph, and from here we can see that the percentage F&B revenue, the total revenue is increasing at a higher pace for PVR than for Inox. Talking about the financial ratio comparison, the beta for PVR is lower as compared to its peers, and also if we talk about P by E versus EPS growth, is not a good position to be in because P by E is higher and EPS growth is lesser for this year. Return on equity is good, so this can be a moderate position to be in for this graph.
As for financial analysis, to start with the robust growth opportunities, PVR had 20 screen additions prior to 2012, which increased to 60, and on the back of organic and inorganic expansions. Inorganic expansions included acquisitions of Cinemax and DD Cinemas, which strengthened its foothold in the northern and western markets, which also improved its premier location advantage and key markets, which drove its F&B and as well as advertising revenues, improving its operating margins. It also focused on southern regions, diversifying into tier 2 markets and improving its diversifiable content and platform for different consumer segments from PVR director cut to PVR talkies, improving consumer propensity, better movie plight and income levels only increase the robust growth opportunities. Revenue growth in the past is variable on the back of its expansion plans, especially in FY14 where it acquired Cinemax. And moving forward, it will be in the range of 16%. Segment-wise, the CAGR is expected to grow at 20.5% for film exhibition, 25% for advertising, and 15.5% for F&B. As for screen distribution, it is expected to be more concentrated towards southern regions in going 5 years, with proportional decrease in western and northern regions. Rent renewals form a major cost for PVR, and strong screen additions will attract higher rental rates on the back of bargaining power for mall developers, inadequate malls, and increasing competitive intensity. Whereas it will rise to tune of 19.9% from a current 16%. Margin expansion will be driven by strong revenue growth, but EBITDA growth as well as margins are variable in the past on the back of its expansion as well as acquisition of Cinemax. And going forward, it will be more stable rate for EBITDA growth of 16%, and EBIT will rise to 11.8% and 7.7% for PAT. MAT credit entitlement is expected to be expensed, and it will only improve the profits and profit margins. As for return on investments, ROE is expected to be driven by net profit margin going forward, whereas it was driven by financial leverage in the earlier part of 5 years. ROC is expected to be greater than what WACC, and expected to drive shareholders value, which was sort of variable in the last 5 years. Company is expected to fund its capex through its internal accruals, and that has been driven. That has always been constant for the last 5 years, and expected to be same in the future as well. To begin with the DCF assumptions, we have done it on the basis of revenue segments. Screen-wise addition we've identified on the basis of regions, that is northeast, west, south, as well as tiered markets, and expected to grow by 65 screens per year and to reach 1,000 screen marks by 2022. Film exhibition cost will reach a global average of 52% from the current 38%, whereas ongoing rents will rise 5%, and the rent renewals will rise to the tune of 1.5 times the existing rates. MAT credit is expected, we have modeled to expense in the next 3 years, which will improve the profit and the margins. GST rate, although variable to be, we have modeled it to be 18%, which decrease entertainment tax and increase the VAT. A VAT increase will also affect the F&B margins negatively, but nevertheless revenue will increase by 1.5% and to reach the average of 50% of net box office collections, whereas the F&B cost to revenue will increase to 29% in the next 3 years. Advertising revenue on the back of premier location advantages which PVR has, and the increase in footfalls to expansion, it is expected to rise by 5% on a sustainable basis, whereas it will increase by 15% in the short term. Modeling all those assumptions as well as the WACC for 10.18% with cost of equity of 11.32% and a cost of debt of 8.8%, we are coming with a target price of 1227.3 based on the DCF assumption of free cash flow to firm. For relative valuation, we have identified peers from emerging markets, namely China, Hong Kong, Thailand, Philippines. With Indian, Inox is the only listed firm apart from PVR, with Carnival and Casinopolis are not listed but the major players there. We have identified P by E and EV by EBITDA metrics to identify the target price of 1218, giving equal weightage to both these metrics and which supports our DCF intrinsic price. We have also identified target price sensitivity, identifying sensitive parameters, starting with occupancy rate and average ticket price. Occupancy rate has been varied from 30 to 36%, whereas average ticket price is varied from plus minus 10% to arrive at a different target price. Same we have done with WACC and GST rate. GST rate has been modeled from 17.5 to 20%, where WACC has been ranged from plus minus 1%. On both sides, and then we have also done something with terminal growth rate, which is varied from 4 to 5.5% to arrive at the different target prices. In all, we have used these two methods, free cash flow to firm relative valuation, but we're coming with a target price of 1227, but giving 100% weightage to DCF because we feel relative valuation that peers are not in the same market, as well as the size and market business is always different. So we're coming with 15% upside on the current market price, and we're going to buy recommendation. On investment risk, we feel the inadequate mall supply as well as rise in the food prices, F&B prices, as well as competitive intensity from foreign local players, high entertainment tax, as well as price cap on tickets, all play a major role in key investment risk which PVR holds. Restrictions on acquisitions as well as rise in the salary cap, rise in the over-the-top services like Netflix and Hotstar present a great investment risk to to PVR, and although privacy and leak threats have also been there for PVR, which also is a key investment risk for PVR. Apart from this, competitive intensity and acquisition by foreign and local players have increased the competitive intensity, and this is going to affect the PVR in terms of its rental rates, and going to impact it negatively. Although it will have to go through its expansion route and focus on. Thank you.
Some of the multiplex players, including PVR, have acquired other players in the recent past. Okay. Have you used that data to analyze what those businesses were valued at? And from that regard, is there anything that you can draw inference about the current stock price of PVR?
We'll take a minute. In the past, mainly Carnival Cinemas acquired big cinemas, but the acquisition cost was very high, and they were very optimistic.
I want exact numbers or the range at least.
So we haven't used that data exactly.
Yeah. What is the revenue breakup of PVR versus Inox? The non-ticket revenue of PVR, if I get it right, is higher. So how do they enrich their say, food and beverages and advertisement? What they are doing differently than Inox and other players?
So main advantage that PVR holds is its premium location identification and key urban markets, which is actually able to drive more footfalls and ability to generate more F&B sales. But F&B sales are mainly driven by its innovation in its food categories. They're not restricted to beverages and popcorns, but innovating on more product categories which indulge with ability to indulge more consumers on the basis of that.
So even recently PVR acquired a popcorn business called as 47,000 BC. So because of this, they have been able to offer various products, and that is one of the reasons because of which F&B sales are high for PVR.
Apart from this, the PVR mainly focuses on the experience part. If we see about the PVR versus Inox, the PVR has lesser sales per screen. So it is focusing on the experience, and therefore it is expecting the customers that will come and experience and buy F&B more than Inox. So that is one of the differentiator than Inox.
If you look at the valuation, the ROE, ROCs are in mid-teens or maybe low teens, right? What explains so much of euphoria for a business which is generating ROE, ROC of low teens?
This is a very growing industry. This is considered to be a very perpetual kind of industry where films are going to be produced in India. Around 1,000 films are produced in India. It has been seen in USA also that even in a recession period, this kind of industry was not hampered because of any kind of recession. So it was considered that this is a very euphoric and energetic industry where this growth will sustain in any kind of economic cycle.
So the company has got aggressive plans. It has plans to expand the number of screens to 1,000 by 2020. That is what the management guidance says. So the kind of growth that the company envisions itself, we think that is the reason for to be very optimistic about this company.
If you look at the cash flow from operations to capex, it is more than 1, so or closer to 1, very close to 1. So company is not going to throw free cash for growth. So the growth is coming by putting incremental capital. It is there is not a very high operating leverage. So why do you think the return ratios will improve? I can throw as much capital to grow, right? So, but that's not value accretive.
So to start with, capex requirement will be on the basis of new screen addition and maintenance capex, so that is always required. And what CFO by capex it tells us that it will be able to fund it on the basis of internal accruals without taking minimal debt or as and when required. Now capex actually will be required for that reason. And
so from past position we can also see that the most of the 80% of the market share is concentrated in the 4 firms, namely PVR, Inox, Carnival and Cinepolis. So PVR, Inox, Carnival and Cinepolis. So 4 of these have grown by only through acquisitions. So if we talk about the Carnival Cinemas, and they're planning to expand by 2018 1,000 screens. So they are planning by acquisitions. So the capital will be needed for.
My question was why growth will be value accretive? Why will ROE and ROCs expand?
So primarily it is in film exhibition business, but due to its certain distinct advantages like ability to select proper locations, primary location, key urban markets, it is able to drive other non-ticketing revenue also, like F&B sales and advertising sales, which are adding to its operating margin. Like ticketing sales will not generally add to its operating margin, but F&B revenues and advertising will add to the operating margins, and increasing those will actually increase the return on investments going forward, because that will add to your profit margins, and ultimately even ROC will increase because of that. And to do that, they will require some capex, could continuously improve and innovate on their different one, because they provide differentiated experience, right from a premium PVR director's cut to a more affordable PVR talkies. So they have an affordable range. To do that, they would require capex, and we believe so that it could generate because of different non-ticketing revenues as well.
One question on your free cash flow table. What growth rates have you assumed between 2020 and 2021? So suddenly the cash flow from operations is going up phenomenally.
So in this, what we have done is we have considered revenue.
No, I just need to know what has led to the change between 20 and 21.
So what we have modeled is what we have done is initially we have increased revenue on the basis of first what screen.
My point is you have taken a steady revenue growth. If your costs are going up, it seems like, because capital expenditure is more or less broadly.
Yes, sir.
Then where is that difference coming from? Have you assumed very high profit margins, very low tax? What has led to that increase?
So we modeled revenue according to that, because we have modeled revenue to increase more towards southern regions and also towards western regions. So we have modeled revenue to increase our screen additions, because we have modeled it to increase the 1,000 screen mark from current 557 by 2022. So based on that, we have increased the revenue, and we feel that it will be able to generate that. and plus it will be able to generate some of its revenues more from advertising revenue, because currently it is being generating revenues twice of that of its nearest competitor Inox. So based on all these factors, it will increase the revenue.
It has already been.
Yes.
Between 16 and 17 and 20 also they are doing that. So what is leading to that significant change between 20 and 20?
So
See, from CFO, if you see, there's a jump of 4,000 crores. It is in lakhs, so 611.
400.
Yeah. So 611 crores to 1,000 crores in just 1 year.
So, another thing is capex we are assuming to be in the middle year.